There is a very high probability the Fed is going to cut rates soon. And when that happens, millions of investors are going to do the exact same thing, move out of bonds and rotate their portfolios. To understand why this standard rotation is a trap, we have to look at where monetary policy actually originates. Right now, there is heavy tension between official inflation data, which is still running warm, and the intense political pressure to lower borrowing costs. For months, the outgoing Federal Reserve leadership has faced sharp criticism. They have been repeatedly called out for being too hesitant and moving too slowly to bring rates down. But the political pressure is forcing a transition. With a new Fed nominee stepping in, the mandate is clear: forcefully and rapidly push those borrowing costs down to the floor. The problem is that the standard advice retail investors follow for navigating a rate drop relies on entirely the wrong economic metrics. There is a hidden 200-year-old mechanism driving this entirely behind the scenes. If you ignore how it works, you will lose ground, while the financial elite use this exact moment to engineer massive wealth. This chart compares typical daily retail spending to the massive surge on Cyber Monday. On an average day, spending is flat, but a 40% discount reliably causes a 6 times exponential spike in consumer purchasing. When things get cheaper, people predictably buy more. Yet it is fascinating that when financial assets or capital go on sale, everyday people are suddenly terrified to buy. We need to rethink what an interest rate actually is. It is simply the price tag for buying money. So when the Fed cuts rates, it is literally throwing a nationwide sale on capital. This visual equation demonstrates how that leverage scales. Think about the cash required to buy a new smartphone. You could use $1,400 to buy the phone, or you could use that exact same $1,400 to pay the interest on a $140,000 loan. Recognizing debt as money on sale is the absolute prerequisite for graduating from a consumer mindset to an institutional wealth-building mindset. This brings us to the Cantillon Effect. The Cantillon Effect is an economic law dictating that whoever is closest to the creation of new money receives all the purchasing power benefits, while those furthest away foot the bill. This flowchart shows how newly printed capital moves through the economy. It starts at the source and pushes directly into level 1. Banks and financial institutions. They get the cheap money first, allowing them to buy assets before market prices have a chance to rise. From there, the funds trickle down to level 2. Large corporations receive this next wave of cheap debt, which they immediately use to expand their operations or buy back their own stock. The critical inflection point happens here at level 3. The massive injection of capital finally triggers the inflation of hard assets. Real estate and stocks shoot up in value, effectively locking out anyone who hasn't bought in yet. And finally, the depleted money reaches level 4. This is where everyday consumers live. By the time the capital gets here, it manifests as rising costs for basic survival goods like food, gas, and utilities, long before wages ever adjust to match. The Cantillon Effect is a designed flywheel. It inherently dilutes the working class's wages to subsidize the asset acquisitions of the financial elite. So instead of waiting at the bottom of the Cantillon flow and letting inflation eat wages, you can jump straight to level 1 by partnering directly with the banks. Banks actually create money specifically through the issuance of debt. This means you access newly printed capital the exact moment you take out a loan. But there is a strict dividing line here. Using debt on a credit card to buy depreciating consumer goods is a trap. The power lies entirely in using borrowed money to buy cash-flowing assets. Billionaires famously utilize massive leverage to acquire vast real estate empires. They unapologetically thrive on using borrowed capital, branding themselves as masters of debt. This is the ultimate wealth flywheel in action. You secure cheap debt, you purchase assets that rise in value, and allow overarching economic inflation to mathematically destroy your loan balance over time. Avoiding debt entirely is financial insanity. Using strategic, good debt instead of bad debt is the exact blueprint separating the rich from the middle class. Now, if borrowing money to buy assets sounds terrifying, you are right to be cautious. Deploying leverage without a rigid safety net is completely reckless and guarantees ruin during market downturns. To protect assets, the elite use the 4 layers of liquidity. Layer 1 is operating cash. Layer 2 holds high-yield funds. Layer 3 contains collateral assets, like real estate to borrow against. Layer 4 is illiquid, long-term investments. Mastering this rigid structure neutralizes the danger of leverage. It allows you to stop being a victim of macroeconomics and start acting as the engineer of your own wealth.